Right to the floor show. Bill Stone, Chief Investment Officer at the Glenview Trust Company, and our trader du jour, Tom Hayes. Tom, let's just get to this market action to start here. There's that. There's the Federal Reserve, which we'll be talking about specifically because we've got a lot of headlines out of a couple of Fed heads who are now saying, wait a minute, we may need to debate speeding up the taper because inflation's not going away. What are you seeing with the flows?
Yeah, well, this was bad news this morning, Liz, about the surprise lockdown with Austria and possibly Germany to follow. But the good news that few people are talking about, we just got word this afternoon, the antivirals are coming. Mm-hmm. The EU approved for emergency use the Merck antiviral, the COVID pill. And yesterday, the U.S. government bought 10 million doses of the Pfizer antiviral. So for this key reason, while in the short term, money has fled into treasuries and into tech and out of the reopening trade, as you referenced, I think as we move through this in coming weeks, as these antivirals come out, we do not believe that the global economic recovery is going to be derailed.
Okay, but then we look, Bill, at I mean, I agree with Tom there, but also, you see the reaction in the treasury markets and not just U.S. treasuries. We're looking at the German Bund deeper into negative territory. But you've got to tell us what you see when it comes to corporates, corporate bonds, and the debt that's out there, because we are just getting this news that the Federal Reserve's balance sheet has just hit a record high of $8.64, I can't even say this, trillion dollars. So, Bill, what do you think is happening here?
Well, I mean, obviously it's the jitters from, again, worries that COVID, or lockdowns or some combination slows the economy. I'm in complete agreement with the vaccines and the therapeutics we're going to have here, and we already have some. I don't think that's likely to happen here in the U.S. to that kind of extent. So do we have another period of on the margin, maybe some weight on economic activity? I think so. But the market's clearly, it's going to try and digest that, there are some more higher probabilities now that maybe we do have a problem. You see it from the yield curve getting flatter, which just means you have, I'll say, a higher probability of a recession here. But again, the numbers don't come anywhere near a point where you'd expect a recession. My view is that the Fed would slow down the tapering if, in fact, they started to see any sort of evidence that we were getting, some sort of massive spillover of COVID that would make us have to get close to shutting down. All that would get reversed. Mm-hmm. So I don't think that's really an issue right now.
Well, slow down. They're talking about speeding it up. We have the headlines from Richard Clarida, Federal Reserve Governor, and he is saying the economy is in a very strong position. And in fact, there is upside risk to inflation, and it may well be appropriate, this is the key one, at the December meeting to discuss speeding taper. And Tom Hayes, that came after Chris Waller, who of course is a Fed governor as well. And Chris Waller said this morning in a speech, we and myself and others are realizing we cannot sit around and wait for inflation to disappear. It's really important that the Fed maintains its credibility on inflation. You're starting to see this in recently signed labor contracts, which of course is a nod to what happened over Deere. Deere had to, was pushed into a contract. Not that that's the worst thing in the world, because workers would like to be paid more. No problem with that. But it's a multi-year contract at a higher rate, certainly. So how does that translate to equities?
Yeah, well, Liz, no one wants to hear faster taper, that's for sure. And if you look, even during Q3, we just got through earnings season. Earnings were expected to grow 27.5%. They actually grew over 40%. So he's right. The economy is running very hot. If you look at GDP now for Q4 from the Atlanta Fed, it's looking at 8.7% growth. So, this economy is running very, very hot. We're hopeful that perhaps they will keep the taper timeline on track, adding $660 billion of liquidity between now and June. And then next year, we look for kind of a high single-digit return, low double-digit return on 9% earnings growth. But we're going to get a lot more volatility next year, Liz, because the market's going to start to realize liquidity is coming out of the system the back half of the year.
Okay. And Bill, if that is true, drill down where you see the best opportunity for your clients and our viewers.
Well, I mean, I think you take advantage of these times when the market does start to get worried about the economy slowing, because, I couldn't agree more. The economy, frankly, at least here in the fourth quarter, also has picked up. So we don't think that COVID is going to show up there. So I think you stay in the banks that'll benefit from a steeper yield curve when we get it, and economic growth, and industrials, where, again, as long as the economy keeps moving along, and probably you get some boost from the infrastructure bill as well.
All right. Lots happening here, and those headlines are certainly important. We're trying to get our viewers everything, and you guys are fleshing it out perfectly. Tom, Bill, great to have you. And we do need to just quickly say that Dow Jones Industrials are on track for a lower close on the week. Now, it is a